Hey everyone, and welcome to today's Explainer. We are diving into Bank of America's absolute monster of a Q2 2026 earnings report. We're going to answer the ultimate question for you. Is BAC a buy, a hold, or a sell right now? We'll break down the raw numbers, the macro environment, and of course the risks, to give you a crystal clear picture of what's actually happening with this financial giant. Let's get right into it.
So, let's address the elephant in the room right off the bat. On the surface, Bank of America might look like a pretty expensive bank stock right now. But if you look under the hood, something truly fascinating is happening. Revenues are growing, earnings are seriously accelerating, and they're throwing capital back at shareholders at just an incredible rate. So we really need to figure out, has the market already priced in all this good news, or is there still plenty of room to run?
To set the stage here, the stock recently closed at $61.69. That puts it right near its recent highs, giving the company a massive market cap of roughly $431 billion. With numbers that large and the stock sitting at these elevated levels, what we're going to cover today is incredibly relevant to how you might want to position your own portfolio.
Here is our roadmap for today. First, we'll look at the big earnings momentum. Second, rewarding the shareholders. Third, the macro rate environment. Fourth, weighing the risks. And finally, number 5, our verdict: buy, hold, or sell.
Section 1. The big earnings momentum, revenue and EPS growth.
Let's start with the bull case because it's a strong one. The absolute crucial point here is this figure, $9.07 billion. That is Bank of America's net income for the second quarter of 2026 alone. To put that into perspective, just 1 year earlier, it was $7.17 billion. We're talking about a massive 26.5% jump year over year.
The trend we're seeing here is honestly undeniable. There's this steady, major acceleration from that $7.17 billion in Q2 2025 all the way up to over $9 billion today. And you know what that proves? It proves this isn't just a story about a bank slashing costs to save its way to profitability. No, Bank of America is actually out there generating significantly more business across the board.
Because at the end of the day, as an investor, what you really want to see is revenue growth leading directly to profit growth, right? And they delivered exactly that. Revenue increased 15% year over year to $31.56 billion, which was heavily driven by stronger sales and a big shift toward digital channels. And that top-line growth translated beautifully, with diluted earnings per share jumping 34% to $1.21. For a bank worth over $400 billion, that is some serious heavy-duty earnings momentum.
Section 2. Rewarding the shareholders, dividends and buybacks.
So, with all that cash rolling in, what are they actually doing with it? Well, they just surprised the market by hiking their quarterly common dividend by a very healthy 14%. Management specifically pointed to the sheer strength of their earnings and their deep confidence in long-term growth as the primary reasons for this generous hike.
Breaking those numbers down, the quarterly dividend moved from 28 cents up to 32 cents per share. That gives us an annualized dividend of $1.28. Now, sure, at a stock price near $62, a 2.08% yield doesn't exactly make BAC a crazy high-yield income stock. But honestly, that's entirely missing the point. The point is that the payout is highly manageable. Their surging earnings easily cover this requirement, meaning they have a ton of runway for that dividend to just keep growing in the years to come.
But wait, the dividend is literally only half the story here. Add in a staggering $40 billion share buyback program, and the scale of capital being returned is just mind-blowing. In just the first 6 months of 2026 alone, they bought back $13.2 billion in common stock and paid out another $4 billion in dividends. That is over $17 billion handed right back to shareholders in half a year, with another $17 billion still sitting there, fully authorized for more buybacks. You are looking at a bona fide shareholder return machine.
Section 3. The macro rate environment. The fulcrum.
Now, obviously, no bank operates in a vacuum, so we have to look at the broader macro context. According to an August 2026 update from MUFG Research, the lack of resurfacing inflation means the Federal Reserve is broadly expected to simply pause. There's just no urgency to hike rates further right now. And that dynamic directly impacts bank revenues because, as we all know, banks are hypersensitive to interest rate movements.
Looking at how this plays out over the next few quarters, MUFG expects the Fed funds rate to stay elevated at 3.625% through the entirety of 2026 before finally starting to ease off in early 2027. Now, for Bank of America, higher rates for longer is great. It keeps their net interest income incredibly strong. But we definitely have to acknowledge the flip side.
It also maintains a lot of pressure on the broader economy, which leads us perfectly into the other side of the coin.
Section 4. Weighing the risks. The bear case.
Every single bullish story has a breaking point, so we have to weigh the risks. There are 4 main things you need to monitor. First up, interest rates. If we suddenly see major, unexpected rate cuts, that is going to heavily pressure their net interest income. Second, credit losses. The good news is their Q2 provision actually dropped to $1.37 billion, down from $1.59 billion a year ago. But if unemployment suddenly spikes, that trend could reverse in a heartbeat. Third is a potential recession, which obviously hurts loan demand and drives up defaults. But honestly, the absolute biggest risk right now is simply valuation. A great company that already has incredibly high expectations priced in is not a bargain bin find at $61. And in this market, sometimes expectations matter way more than the actual underlying results.
Section 5. Buy, hold, or sell. The verdict.
So, let's synthesize all this data into an actionable framework. Ultimately, it depends entirely on your current position. If you already own BAC, it is a firm hold. You really do not want to sell a business while its operating performance is actively getting better. Just sit back and let the earnings and buybacks work for you. But if you're a new investor looking to build a position, it's what we call a selective buy, meaning you probably want to stage your entry over time rather than just going all in right at these current highs.
Breaking this down into specific price zones makes it super clear. At the current 61-69 level, we are sitting smack in the middle of that selective buy-hold territory. It means the stock is definitely good enough to own, but it's not cheap enough to chase aggressively. If it drops back into the 50s while the fundamentals remain strong, bam, it becomes a much more compelling buy. But if it races up above 70 without matching earnings growth to back it up, you simply do not chase it.
When we put it all together on a scorecard, the stock earns a very robust 8.3 out of 10 overall. Notice how crazy high those scores are for earnings, revenue, and dividend growth. The only thing dragging this overall score down is that 6.5 valuation metric, and I think that serves as a perfect reminder for us. A tremendously strong, high-quality company doesn't automatically mean you should buy it at absolutely any price.
As we wrap up this explainer, one thing is perfectly clear. The fundamental strength and the sheer earning power of Bank of America right now are undeniably impressive. Keep an eye on interest rates and stay laser-focused on those fundamentals. But I'll leave you with one final, crucial thought to apply to your own portfolio strategy. When a company is operating at this high of a level, how much of a premium are you willing to pay for that quality today?